So let's start with the simplest one. The simplest one is what's called the depository institutions.
The banks.
Yes. So a bank is created by something called a charter. This is why this whole infinite banking and bank on yourself is like when someone, I'm just going to go off a little bit right now.
All right, go for it. I know you've been waiting for this moment.
Well, it's not so much. It's the lie someone says that says you can become your own bank. And until you can charter your own institution, and until you can take your reserves and you can lend those out and create, money out of thin air, 9 to 10 of what you have in deposits or whatever that would be, then you are not a bank.
No.
Okay? You are not a bank, because that's essentially what a bank can do. A bank that is chartered is allowed to lend money well in excess of what they have in reserves.
Yes.
Okay?
Yes, they sure are.
You cannot do that. So I don't get that concept based upon that alone. All right. So I feel like when most people say become your own bank, now there's obviously methods and ways in which you can take your investments and leverage them. Okay.
Yep.
But it's almost required that you can only borrow up to what you have in assets. I can't do more than that against those assets.
No,
right?
Never.
Okay. So if I have it as an example, if I have $1 million stock portfolio, okay.
Yep.
I cannot borrow $3 million against that $1 million stock portfolio.
No, you'll borrow 600,000 if you're lucky.
Yeah, I would be able to myself be able to do that. Now, a bank may say, okay, we'll take that as collateral, but the bank is doing that and then lending me the money. Like me, myself doing it, I cannot borrow any more than probably 60 to 70% of that to make an investment somewhere.
No.
Okay. Same thing with a house. If you have a house that's, has equity in it, how much you could be able to get out of that?
Yeah. Maybe 80% of the market value.
Yeah. So anyway, I think that's, so that concept it just makes me cringe a little bit, but okay. Let's get back to the depository institution. So we have depository institutions. So these are banks and credit unions and these other types of institutions that are created by some kind of a charter. Okay.
Yep.
And they're generally under the purview of the central bank, the Federal Reserve, which is actually a private institution that's run by private banks. But we're going to not go off on a tangent there either. But that is Congress has basically bequeathed control of the banking system to the Federal Reserve. All right, great. So, okay, but now. What are the safety of banks? How do banks operate? Okay. Banks operate, on
leverage.
On leverage. There's a lot of complexities to banks. There really is.
It's not a simple thing, but
it really isn't. But I think the gist of it is that people deposit money into a bank. And then there's a question of like, do you really own that particular, your money in there? Is that your money? Okay. Yeah. And, I've seen arguments where people make and where technically the bank now owns their reserves. Okay. And then they can lend that money out. And they're probably not wrong. It wouldn't surprise me, all the nefarious BS that I hear. But in practical purposes, you have an account number, your name's on the account, right? I get it. All right. Now, the underlying parts of it, we can argue with, but, we won't do that today.
Yeah, let's not get lost in the weeds.
Yeah, exactly. So, okay. Now, the bank then takes that money, and what do?
They loan it out.
They loan it out, right? And obviously that they're, in most cases, in most sane cases, they can lend out, and I think 9 to 10 to 1. Like for every dollar, they can lend out 9 times that for every dollar of deposit.
Yeah,
okay?
A healthy loan to deposit ratio is a measure of the balance between a bank's lending activities and its available funds, i.e., the money that's been deposited by account holders.
Yeah.
A healthy loan to deposit ratio is typically between 80 and 90%. So yeah, you put $1 in the bank, they're going to loan out $8 to $9.
Yeah. Okay. So then you have to trust that bank is good at lending.
Yeah,
right?
making loans to people who are going to pay their loans.
Exactly. And, by and large, the bank is going to lend out money to people where they know that there's a low probability that they're going to have default rates, and there's going to be a low probability that people are going to pay back their loans fast.
Yep.
Okay. So, and this is where you get into the, risk management of a bank to be able to do that.